All right, in this second part of this class, we're going to hit just a few interesting topics. We won't go into too much detail on this. This is the kind of thing that if you're interested in them, definitely do research because these are dangerous ways to invest if you're investing for yourself. These are ways that you can make more money very quickly and also lose a lot of money. In fact, these are ways you can lose more than 100% of your money. So they're dangerous ways to invest. But if you know what you're doing and if you're comfortable with them, they can add return to your portfolio. I would recommend if you're going to try any of these approaches, we're talking about shorting securities or buying securities on margin. I would recommend that you do it in a paper portfolio first to make sure you have some sense of what you're doing, and then just be aware that the losses can be tremendous. So I would run some scenarios of what could happen and make sure you can handle that. So sorting securities is when you actually sell a security that you do not own. So if you think Apple stock is overpriced, you don't have to own Apple to sell it. You can have 0 shares of Apple and you can actually sell Apple shares. You'd be shorting the security in a way that if the price falls, you make a profit. So if you short Apple at $500 and it falls to $300, you will make $200 for each share that you shorted. I don't recommend shorting unhedged. So I would actually put some protection in. So if you short a security, say at $500, I might buy some call options at say 700, so that if the security goes to 700, if you shorted at 500, it goes to 700, you just lost $200. But at least then, and once it hits $700, if you have a call option that has a strike at 700, then the most you can lose is up to $700. So you limit your losses to 200. If you don't do that, you can have unlimited loss. And when you short a security, because there's no limit to how high the price can go. So I recommend hedging at least somewhere at some point where you say, wow, I just really missed this. When you do that, you're actually borrowing stock from another investor. That investor may not know that you're borrowing their stock. And so it's just part of this process. It's called securities lending. It's a huge industry. It goes on all the time with most mutual funds. It's really quite common for large company stocks. You can add a few basis points to your portfolio by doing securities lending. For smaller company stocks, you can make even more money doing securities lending. So most mutual funds do it as a way to enhance the return of their portfolio. When you borrow that stock from the other person, you have to give them collateral, and then you have to pay a low interest. They'll pay you a low interest rate on the collateral, and they'll usually take your collateral and invest it and try to make more money. This is called securities lending. It is a very large industry and has had few losses over time. It's actually been a fairly well managed industry. There are some people who very much dislike the ability to short securities. In 2008 especially, people were shorting bank stocks, and there was some feeling that they were shorting bank stocks and then putting out really bad news on banks, hoping that the prices would fall. So there was some sense that the shorting of securities was actually making the market more volatile and causing prices to fall more. And in some cases, governments have actually limited short selling in certain industries to try to protect those industries. I actually think they're very healthy. If markets are expensive, allowing investors to short securities in order to show that and make markets more efficient, I think it's a good thing. Shorting securities can set up something called paired trades. And the interesting thing with paired trades is that you can set up a scenario where you can make money or lose money completely independent of the market. You would be what we call a beta of 0. So your returns, whether you do well or badly, is completely unrelated to whether the market's going up or down. What you would do is find 2 stocks in the same industry, and the one you think is undervalued, you would buy it. The one you think is overvalued, you would short it. And in fact, you might look for 2 stocks, say maybe like CVS and Walgreens, or a stock like Home Depot and Lowe's, that generally move together, but you just noticed that they weren't moving together. One shot up when the other one didn't, or one shot up and one shot down. You might actually buy the one that didn't go up and short the one that did go up, thinking that they would come back together over time. We've done trades like that in our UTSA Investment Society portfolio where they worked very, very well. So you're looking for two stocks that generally move together, but they recently have separated, and you buy one and you short the other. If the industry falls, say 30%, so that the stock you're long on fell 20%, but the stock that you're shorted is down 30%, you still make a lot of money. You're doing very, very well. As long as the stock that you shorted is down more than the stock that you went long on, you make money. However, the other side, um, if your stock is up 30%, but the stock that you short is up 45%, even though both are up and the industry is up, you can lose money. There's actually hedge fund strategies called market neutral where they do this, and their goal is to have a beta of 0. Most of them don't have betas of 0. They're actually betas maybe 0.2, 0.3. They actually have some exposure to the market just because of their philosophy. It tends to follow market trends. But it is a way to limit your market exposure. And if you really believe in active trading, you really think you have good ideas, to me, it's the best way to go if you really have that kind of confidence. Again, I would not recommend shorting securities without practicing with the paper portfolio or without hedging your potential loss just in case the stock does take off. Buying on margins, another way you can enhance the return of your portfolio and also lose a lot of money. And here you use your brokerage service and you buy a stock, say you want to invest 10,000, but you put 5,000 of your own money in, and you borrow $5,000 from your broker. Brokers make a lot of money off of the margins they make off of people using margin trading. So it's a big part of the return, especially now when brokers make almost no money on commissions because commissions have gone almost to 0. So the margin interest rates that they make is about the only way they make their firm profitable. If you borrow $5,000 to invest 10,000, so you have 5,000 of your money and 5,000 of borrowed money, and the value of the portfolio goes up to 15,000, you've essentially made 100% of return, where without the margin you would have only made 50%. So it does enhance returns, but in the same way, when the market falls, you can lose more than 100% of money. So you have to be really, really careful with these type of strategies. The next area that I think is important for us to understand is the expenses you have with investing. And we'll break that up again between the times you do it yourself versus the times where you hire someone else to do this. So if you invest for yourself, there are 3 costs you have to worry about: commissions, the bid-ask spread, and market impact. If you're a small investor, the first 2 are the biggest. If you're a large investor, the third one is the biggest. So let's start with commissions. Commissions is what you pay per trade. And those commissions in the 70s, my understanding, I wasn't trading at that time, but just reading articles, that commissions were $40, $50 back in the 70s and actually were regulated to keep them high. And then there was deregulation and commission prices fell dramatically. And now today, I know in the broker I use, Charles Schwab, I essentially do my trades for 0. So commissions have gone all the way down to 0. So that's one area where finance has actually gotten much, much more efficient. The bid ask, I still have the bid ask issue. The bid ask is what those that are set into trades for you is the profit that they're making. The ask price is what you have to pay if you buy a stock. The bid price is what you receive if you sell the stock. And so if you were to buy a stock this morning and sell it immediately, you would still lose a little bit of money because of that bid-ask spread. The more liquid a stock is, the narrower the bid-ask spread. The more illiquid a stock is, the wider. And in fact, if you want to be careful in a trade, do look at the bid-ask. If it's a very wide bid-ask spread, think of it in percentage terms, not in absolute dollar terms, because stocks with high prices will have a higher bid-ask spread than stocks with low prices. So think it in percentage terms. Take the difference between bid and ask and divide it by the stock price. If that's a large percentage, you may want to refrain from trading on that stock because it's a very illiquid stock and you're losing a lot just doing the transaction. That's why firms that trade a lot in their portfolios can really do harm to their portfolio, because every time they trade, they're losing that bid-ask spread, whether they're buying or selling. So small investors have those first two costs. Large investors, the market impact. This is the impact you have because you're trying to trade a large number of stocks in a large block, and the trade itself causes the stock price to fall. So you're trying to sell 1,000,000 shares, and that's a high percentage of the daily float. The daily float of a stock is how many shares it trades on a normal basis day to day. If you're trading a block that's much higher than the normal float, then you're going to drive that stock price down, and you'll get a lower price than you expected because you moved the market down because there just were not enough buyers to handle your sell. The trade volume is very, very important. What we did in my job, and most large investors do this, is use a transition manager. The transition manager will try to get best execution to try to reduce that market impact. This is a large industry, very specialized industry. You really do not know how good of a job they're doing because it's very statistical. They tell you they think we saved you this much, but they don't really know because you don't know what price you would have gotten if they had traded another way. Small cap fund managers worry about market impact costs because their stocks are not very liquid. And because of that, when their funds get really large, like the few $100 million, they may actually close their fund to new investors to limit their market impact, which is pretty incredible because they make money as a percentage of the fund. So they might make 1% times the fund, that may be their fee, and they're actually reducing their income by closing the fund down to avoid that market impact. So it's a pretty important consideration. All right, so what about if you hire a manager? What costs do you have? So you have a portfolio management fee, and we saw that in the market. If we go into Yahoo Finance, and I don't have Yahoo Finance set up here. Sorry about that. If I go into Yahoo Finance, if we look at a mutual fund, say like the Fidelity Contra Fund. I think we did this in an earlier class when we were talking about the importance of looking at fees, and that may be one of the most important things you do when you're choosing between managers, especially if you have two managers and you're not sure which one you like better. Then just go based on fees, and you'll probably, on average, do better that way. And of course, my machine's really slow here. So, yeah, that's an important part of looking at fees. You have the portfolio management fee, and that is going to be stated as part of the right. Let's now look at the costs when you hire a manager. We talked about this earlier when I mentioned that management fees, portfolio management fees, is one of the most important things that distinguish good funds from poor performing funds. Here you can see I have the Fidelity Contra Fund loaded. We looked at it before. If you look at its profile, when you click on profile, it will actually bring up the management fees for this fund. And the fees you have to worry about are the portfolio management fee, and then do they have any front end loads or exit loads? I would never buy a mutual fund that has a front end load or an exit load. You do have to look at the portfolio management fees. Anything over 1% is fairly ridiculous in this market. In fact, you should probably look for funds that are well below 1%. If you look at Fidelity, its fund is 85 basis points versus the category average of 1%. That's still pretty high. 85 basis points is still pretty expensive. You might want to look at the 12B1 fees. I don't like 12B1 fees. That's extra expenses you're paying because they are using some financial planner or some financial intermediary to push their funds. It's not a good way to buy mutual funds because the person making recommendations to you is essentially getting a kickback from the mutual fund company to push their funds. So I don't like those. And then again, front-end loads, exit loads, I would not buy any fund that has those. There's no evidence that they actually provide any value to you as an investor. So keep the portfolio management fees low, avoid front-end and exit loads. There is a very famous article I'd recommend that you read by William Sharp, where he talks about active versus passive managing, and he argues that active managing will always underperform passive portfolio management because of the fees. It's an interesting article. You can read it. Very straightforward. And his argument is, since you take the entire market, it must be the market. So if all investment managers make 8%, the market must make 8%. Index managers, by definition, make 8% because they are buying the market. So that means active managers must also make 8% because you need the whole market to add up to the market. Since passive managers charge very low fees and active managers charge high fees, passive managers on average must beat active managers because of the higher fees. You will also get that from Jack Bogle. His book, Don't Count on It, is an interesting book. It's not a great book in the sense that it's a little repetitive. It's not really a book that was written cover to cover, but instead a collection of his articles. So there is some redundancy, but he has a lot of really valuable things to say. So I do think it's valuable either to read his book or go to YouTube and find YouTubes where Jack Bogle is speaking, and you'll hear pretty basically everything he believes in those interviews. He's very consistent in message. So some ask, well, if you're not going to do active management because you want to avoid the higher fees, what does that do to the social purpose of investing? Don't investors help us decide which firms are going to win and which ones are going to lose? Don't active managers make that what we call allocative efficiency of the market, where they make sure to penalize badly managed firms and poorly managed firms, and they make sure well-managed firms stay active? And that has been an issue. Active management is still the majority of the market. Indexing is still not anywhere close to being half the market, even though it has been growing quite dramatically. And I have seen some indication, I think is very interesting, firms like BlackRock that are huge passive investors, but also have a lot of active investing portfolios, that the active portfolio managers will actually vote the shares for the passive funds that they manage, so that there is still scrutiny. Since the active managers have to look at the votes that they're voting, the proxies they have to vote, since they're already doing that analysis, they can give great insight to the passive investors how to vote those shares. So I think there is, even with passive investing, an active investor in the background holding management to do the right thing for the stockholders. That does bring up something Warren Buffett has said. If you're going to be an active manager, you need to be patient, because he said investing is like batting without strikes called. So active managers should have patience. Unfortunately, my experience is, it is true, if you're patient, you probably can do much better in this market. There are some things you can do that if you just wait it out and ignore the gyrations in the market, there are things that do work very well. Unfortunately, in my job, I found that portfolio managers, we were paid to swing. We were actually discouraged from being patient, and that's a very frustrating part of the investment world. So you have to have a good boss, one who is patient, who's willing to let you be patient. So expenses very important in the investment world. Next thing we'll turn to in the next videos, we'll start talking about return risk.